If you see something that's kind of needs a little more tender loving care on the outside, chances are it does on the inside as well. So you can usually take advantage of that conversation. Real estate agents, let real estate agents know that you are in the market for investment properties. I know I get at least two or three a day from people that are looking to invest or people representing investment companies in the area. They want to do fix or flips. Again, for the real estate agents that are on the call with me today, please note, be honest, ask them questions, ask what their expectations are. If they're looking to leverage what would be your commission to drive a better deal on the property, that's not going to be lucrative for you. Don't be afraid to be honest and tell them nope. Tell them what you're all about and how and when you are available to help them with their searching. Also, please talk about what type of properties they're looking for. If they are literally sheets to the wind and have no idea, oh, I'm open to anything, then they are not a serious investor and they don't understand, and they're not getting the type of advice that we're giving to you today about making sure they're specializing in a certain area so that they know how they can actually maintain their portfolio strategy. And then, of course, partnering with other investors. People that are truly interested in this need to educate. So they should attend investor groups, look for investors who wish to partner with someone else, thoroughly vet and potentially partner to ensure that they've got some experience, and make sure that the resources that are available to them create a detailed partnership agreement. Just because they have a fancy spreadsheet that's doing some smart math for them right in front of you does not make them a good partner to work with. You need to find people that you can trust, and you need to put the legal documentation in place to give you each clear responsibilities, clear line of action, and exit strategies if things just don't work out. Little flash up to Zillow. Zillow is still one of the key market search engines out there, and it's kind of a go-to site for people that are looking for homes in the United States. They attract a whopping, 231 million unique visitors every single month. So you can easily filter listings by location, price range, lot size, home types, status. When checking out listings, you can find info on how long the home's been on the market, its purchase history, taxes that may or may not have been paid, what type of property it is. Don't build a story. Call an agent if you're finding it on Zillow, or call the owner directly if you are interested, and ask the right questions. Make sure they know what your intent is. If they are difficult to work with on an initial phone call, chances are they're going to be a whole lot worse when you start throwing paperwork in front of them. And if you're dealing directly with owners, do not assume that they know what they're doing or they know what kind of paperwork that you're putting in front of them. Be open. Again, partnering with the real estate will get you out of a lot of this jam, but be open and honest and transparent in what you're trying to achieve. And for obvious reasons, use the state accredited contracts for real estate so that you can, and do your due diligence, but make sure you can fill them out correctly. And typically those will be reviewable and acceptable by any attorney in the state. Step 4 would be evaluations. Once you have spotted potential real estate investment properties, it's time to start digging into the details, especially before you move forward. We call this the due diligence period. Gather the property's history, recent sale prices, things that have happened in the area, homes that have sold in the area. You need to look at market trends. It's also very good to look into rents, check the property's conditions, know local zoning rules to make sure you're not going to fall into any traps, and building code requirements. Depending on the neighborhood that you're in, hit some of their social groups and see what's the chatter, what's everybody complaining about. There may be a new ordinance that's coming through or a new city zoning that's happening, and they're building a Walmart right next to your community that you're looking to purchase in. If that's not your cup of tea and that's not what you're looking for, then don't buy in that market. Cash flow. You got to understand projections. As a part of your business plan, you want to create a cash flow forecast. And this is based on property's income, the expenses, typical vacancy rate, meaning how much of your yearly time is it rented? What's the percentage of that? You're typically looking for 100% or as close to it as possible, that you want it to be rented, supplied by a tenant. You also want to add overhead expenses by filling in that business entity, advertising cost, real estate, commissions, finder's fees, taxes. These are all the costs of doing business. And don't forget, if you're using other people's money or bank's money, you need to know what the mortgage principal and interests are. These all get deducted from your rental income on a long-term investment strategy or your gross selling price on a fix and flip to see if the property is going to have positive or negative cash flow when it's time to turn it. And what are your margins? What are your expectations so that you know what you're targeting? You don't have to take it on the chin because you want to sell quickly. Hold on to your investment a little bit longer. If the market is acclimating correctly, sometimes time is your best friend. Also, you must consider the consequences if you sell. If you need a couple of real scenarios, I can tell you here's at least one. I could probably think of two off the top of my head that new investors don't often consider. So example number one, if I am planning to fix and flip a property, I am subject to short-term capital gains and cannot do a 1031 exchange. Reinvesting those profits into a new property to avoid that tax burden on a 1031 is not going to be allowed. Example two, if I like to buy and hold a property, take the depreciation on my taxes and sell it before the 27.5 years on a rental or residential investment or 39 years on a commercial property, I am subject to pay depreciation recapture on those properties. So if you think you're just going to go out there and become a flipper because you saw it on HGTV and it looks easy enough for that cute couple to do it, maybe my husband and I, or my wife and I, or my personal partner and I can do the same thing. Understand the metrics that we use. We talk cap rate, we talk gross rent multipliers, we talk cash on returns, we talk about evaluation potentials for profitability. Don't get too far into the weeds on all the terms versus following the money and understanding how much is it going to take to get involved. What's it going to take for my time and my energy for my investment? How long am I going to plan to have this investment? And what are my potential returns? How much money am I expecting that I want to make? Because that may tell me how long I'm going to hold on to the property. Step 5, funding. Yeah, everybody's going to be surprised. I'm going to get hit in the comments, and I'm getting laughy faces that are climbing up right now. People, I realize that I'm waiting until halfway through this conversation to talk about finding your funding. And as a real estate broker, I'm telling you, I would typically advise you to find your funding first. But it's different when you're a real estate investor. So bear with me a second. When you're going to get into real estate investing, the next thing you need to consider is how much do you truly need to invest in real estate and how you're going to get to that money. Depending on the type of investing you're doing, the properties you have your eye on, your financial situation, your financial buying strength, you might even have access to various funding sources. There are things that you need to look at to provide this funding and security for this new investment strategy you decided to get involved in. Personal savings. You can use your own money, and it can be the cheapest way for you to finance real estate deals. Cash on hand will let you move quickly, and you don't have to worry so much about loans, mortgage, interest rates changes, and the time it takes to get it financed, you're losing investment opportunity. Conventional loans would be the next one. Conventional loans can be obtained by any credit union or a bank. There are a ton of MLOs out there I can also refer for you. But credit unions, being nonprofit, offer a lower interest rate typically, and this is why their fees are usually a little more flexible. Loan approval process, however, is a little more drawn. So you need to take the good with the bad and decide whether this is going to serve a specific purpose. And they typically like to back investors that are serving their community. So make sure you have a meeting with these banks before you do business with them and have a real conversation on how you're going to help each other, because they like to advertise that they help their local communities. If you're not actually doing that, they're not going to be so open to doing business with you. Next, government loans are capability. You can use these loans from, you have limitations, but FHA or VA in the U.S., there are even, if you're into a little more rural setting, there are USDA loan availabilities out there for qualifying areas. And if you find that your financing options are open to that, certainly take advantage to smaller fees, easier terms, a little quicker financing option. These are all things that could be to your advantage. The HELOC, home equity line of credit. If you already own a property that has significant equity in it, and again, this is, I have mortgages or I have liens against my property, and this is what the property's worth. That gap is your equity. How much money is it worth above its debt service? If you already have that, then you can use a line of credit against that equity to fund your next real estate investment. Essentially, you've done so well with this purchase, or you paid so much of this purchase down, that you can use that remaining credit to essentially get yourself a credit card to buy other real estate properties. It works very, very well. You can also use it in your fixing and flipping plan, if that's the business plan you decide to go with, to be able to sink those funds into the investment of getting the other property ready to up and serve. Private money lenders are also available. I realize they have had a lot of names over the years, but let's just call them private money lenders. These are individuals or private companies that provide loans for real estate investments specifically. They believe in the real estate market. They believe in the safety behind putting those marketable properties as collateral. And it may even offer you some more flexible terms than a traditional bank, because they'll do probably a shorter timeline for you. And depending on your buying power, possibly less risk, as long as you're willing to sell your property in a short term. They're going to charge a little higher fees, but in the long run strategy, you may find this to be a much faster and an easier conversation to have, especially if you're going to be building a portfolio quickly. Hard money lenders are a little bit different. These guys typically have a short-term period, like 18 months or less. Hard money loans can be for as long as, I've seen, 3 years, but they involve a lender or an investor group that's giving you money directly. Hard money loans are most common for fix and flips because they do not have a strategy to be kept for a long period of time. You have confidence in the strength and the mobility of the market, so you want to be able to continue to do that. Seller financing may become more and more popular if the interest rates stay high. But in this scenario, the seller of the property will actually act as the lender, allow you to make payments directly to them instead of to a bank. So they will also probably charge a higher interest rate or push you for a shorter term, or offer a balloon payment, meaning that they will finance you for the first 5 years. But after that, you are required to invest a loan somewhere else if you're not able to pay it off yourself. SIDRAs, the self-directed individual retirement accounts, can be leveraged in this too. This method will allow you to use funds from like your IRA to invest in real estate, providing potential tax benefits to that as well. And these are usually government backed, and they support that type of tax protection, so that you can utilize your investment without withdrawing the investment itself. We talked about partnerships and joint ventures a little bit. You can always partner with other investors, pool your resources, invest in real estate. I know a lot of my foreign clients like to do this. They like to do this with family and relatives and friends, and they usually have pockets of investors in their community that like to share this together, so that they can spread the risk out and leverage different skill sets of the different members of their family and friends group to be able to essentially create a long-term wealth plan for each other. And then, of course, your immediate family and friends. You can always do this yourself. You could be a great resource for investing. Structuring loans so that everybody gets a return on the investment, provides a short-term payback date, say, 24 to 36 months, and have a solid plan on how everybody is going to get their money. One of you will need to be the real estate expert. Somebody else will need to bring their skills to it as the primary investor. Again, the person may only offer sweat equity in maintaining and rebuilding and whatever they're going to do as far as the business strategy, but everybody needs to pull their weight.